faithfully delivering value and interpreting great books from around the world. Hello, this is Sally talking books. Today, we're interpreting the book Common Stocks and Uncommon Profits by Philip Fisher, the American master of value investing. Warren Buffett once said that his investment philosophy is 85% from Graham and 15% from Philip Fisher.
Both Graham and Fisher are key founders of modern value investing theory.
Graham focused on a company's current value, seeking stocks priced well below their asset value,
whereas Fisher emphasized the future growth potential of companies, looking for those with sustainable competitive advantages. Fisher pioneered the strategy of investing in growth stocks, earning him the title Father of Growth Investing. And Buffett's investment style after the 1980s actually became closer to Fisher's. Fisher was born in 1907 in San Francisco, USA, to a family of Jewish immigrants from Europe. Fisher's father was an orthopedic surgeon. As the eldest son with a younger sister, Fisher was homeschooled from a young age. As a child, Fisher often overheard his grandmother and friends chatting about stocks, sparking his curiosity in stock investing.
At age 14, he used his saved pocket money to try buying stocks and surprisingly made some profit.
Of course, the main reason was because the U.S. stock market was in a major bull market during the 1920s. Fisher attended Lowell High School, a famous school in San Francisco. He graduated high school at 16 and went to UC Berkeley for college, later studying at Stanford University's business school. Stanford had a weekly activity visiting local large companies led by Professor Boris Emmett. Fisher, who bought a car with family support, volunteered to drive Professor Emmett. This way, he could legitimately follow the professor around visiting companies and discuss his views on them during the drives. This valuable learning experience laid a solid professional foundation for Fisher's future company research and steered his career toward the investment industry. In the summer of 1928, Fisher graduated from Stanford Business School and became a securities analyst at National Bank in San Francisco, starting his investment career. And in the bleak stock market of 1932, the 24-year-old Fisher founded his own stock investment consulting firm. He started his investment career in a tiny office that could only fit one desk and two chairs, with no windows. From 1932 to 1933, his income was about the same as that of a newspaper boy at the time. Reflecting on these tough times, Fisher recalled, "It's precisely because of these years that I had the later days. You could say they were the two most bountiful years of my life." Through relentless effort, by 1935, Fisher had built a loyal client base with solid investment results and a big jump in income. After that, Fisher's investment career progressed smoothly, delivering outstanding performance. In managing investments, Fisher always had to constantly explain his principles and methods to investors. So he decided to write a book about his investment philosophy. In 1958, Fisher's book Common Stocks and Uncommon Profits was published. It became the first investment book on the New York Times bestseller list, quickly making Fisher a star in the U.S. investment world. And Warren Buffett, then young, loved Fisher's work so much that he personally visited Fisher to humbly seek advice. Buffett said Fisher was much like Graham, humble and generous, making him a very special teacher. Fisher's investment philosophy had a huge impact on Buffett's lifelong investing. Fisher loved investment work his whole life, only retiring at age 92. Beyond investing, Fisher found great fulfillment teaching advanced investment courses at Stanford Business School. Its Common Stocks and Uncommon Profits also became a textbook for Stanford's investment courses. Unfortunately, in his later years, Fisher developed Alzheimer's disease. In March 2004, the great investment master passed away at the age of 96. In the book Common Stocks and Uncommon Profits, Fisher reviewed his investment journey and summarized his growth stock strategy. Next, I'll break it down into 3 parts to interpret it specifically for you. First, how to choose growth stocks. Second, how to conduct company research. Third,
When to buy and sell stocks.
Let's start with the first question: how to choose growth stocks. In his investment practice, Fisher summarized 15 principles for selecting growth stocks, which are essentially 15 key points for researching growth companies. These 15 key points are divided into two aspects. One is the company's team, including management and corporate culture. The second is the company's operational situation, involving four aspects: production, research and development, sales, and finance. Fisher combines these two factors to find the best companies. First, let's look at the company team. Fisher believes that people make a company capable, especially the integrity and ability of its management, which play a decisive role in the company's future development. Therefore, 6 of Fisher's 15 principles are about people, such as whether management is honest and upright, whether they report only good news and not bad, whether labor relations are good, whether management gets along well, and whether leaders are truly committed to developing new products or technologies. Whether the company has an exceptionally capable sales force. Today, when investing in listed companies, we generally recognize that researching people is crucial. But in the 1930s and 1940s, investing focused mainly on valuing a company's tangible assets. Fisher proposed at that time to conduct comprehensive and in-depth research into human factors, which was undoubtedly a major advancement in stock research. Looking at company operations again, Fisher said that what drives stock price trends is the future, not the past. Fisher's research isn't about summarizing past business operations and history, but about making forward-looking judgments on a company's future growth. And this is precisely the key to the growth stock investment strategy pioneered by Fisher. Fisher mainly looks at 3 points in his analysis of company operations. The first point is whether the company's products and services have sufficient market potential and whether revenue can grow significantly. And if the company's products can meet market demand well, and total market demand is in an explosive phase with great future potential, this will bring a rapid development phase to the company's business performance. This can be divided into two situations. One is when the industry is at a peak, with exploding industry demand creating opportunities for the company. The other is when the company itself launches innovative new products or services, opening new market demand and driving company performance growth. But strong market demand alone isn't enough. Prosperity often attracts more competition, leading to intensified market rivalry.
Therefore, Fisher judges from the team's perspective whether a company has the ability to sustain future business growth.
Fisher's second point of analysis is whether the company values new product R&D and how much it invests. R&D costs money and usually doesn't yield immediate results. But the larger the investment in new product R&D, the greater the company's future potential. Because R&D builds technological advantages, and successful new products create fresh growth opportunities that drive sustainable development. So whether a company prioritizes R&D investment is crucial in determining its growth potential. Now, in today's rapidly evolving tech landscape, top companies invest even more heavily in R&D. For example, in 2019, Apple invested 110 billion yuan in R&D, while Huawei invested even more, reaching 130 billion yuan. And Fisher's third point examines profitability, how strong the profit margins are, and whether the company emphasizes cost analysis and financial controls. Typically, companies with higher profit margins are more profitable, and industry leaders often have the highest margins. A key way to boost profit margins is through cost control, especially for manufacturing firms. If production costs are lower than competitors in the same industry, that's a powerful competitive edge. So, companies skilled at controlling and reducing costs typically enjoy better profitability. But Fisher also reminds us to examine future profit margin trends when investing. For example, a young company in its growth phase might buy equipment, expand production, build a sales team, market products, or develop new ones. All this costs money. At this stage, expenses run high, temporarily depressing profit margins. But as long as these efforts fuel company growth, higher profitability will follow. So, temporarily weak profit figures are acceptable. In fact, this is often a prime investment opportunity since poor financial data leads to undervalued stock prices. In summary, Fisher sought companies with the strongest competitive advantages. These firms boast exceptional management and genuine strength across production, sales, R&D, and finance. By continuously innovating products or services, they lead industry trends and achieve revenue or profit growth far exceeding industry averages. Meanwhile, their stocks haven't been chased by the market and become overpriced. In the future, as the company's operating performance keeps growing, the stock price will continue to rise accordingly. Well, from 1954 to 1969, these 15 years were Fisher's most glorious period in investment performance. The gains of the stocks he bought far exceeded the market index. Fisher's investments focused on listed companies in U.S. manufacturing, and he was very successful in the electronics, chemical, metallurgical, and machinery industries. Among them, his investments in Dow Chemical, Texas Instruments, and Motorola, these three supergrowth stocks, were the most classic and successful. Next, we'll discuss two of these cases. The first case is Fisher's investment in Texas Instruments of the U.S. In 1955, by chance, Fisher learned about Texas Instruments, a small company in the electronics industry. Its four founders planned to sell some shares to raise funds for buying land. After learning about it, Fisher conducted an investigation and decided to accept the shares transferred by the founders of Texas Instruments. And finally, I was no more the way I could tell. Both parties agreed on a price of $14 per share. Based on the predicted earnings per share for the next year, the P/E ratio of the transaction price was 20 times. According to the company's past performance and traditional market valuation standards at the time, this deal seemed overpriced. Moreover, market investors at the time classified small companies like Texas Instruments as speculative and weren't optimistic, but Fisher didn't think so. After his research, he believed that Texas Instruments had great potential in the semiconductor field because the company had an excellent and capable management team with sharp market judgment, a focus on R&D, and was actively promoting production automation, aiming to become the largest and lowest-cost manufacturer in the industry. Fisher believed that Texas Instruments management could face off against much larger competitors in the industry, and in competition with General Electric and Westinghouse, they could at least hold their own. Although Texas Instruments was much smaller than its rivals, its product market share was very high. Besides the semiconductor business, Texas Instruments' geophysical and military electronics businesses were also growing steadily, yet the market stock price didn't fully reflect the company's true growth prospects. Looking back now, we can clearly see that 1955 was the start of the first golden age of the semiconductor industry in the U.S., lasting 15 years. From Fisher's purchase of Texas Instruments in 1955 to 1962, the stock price rose 14-fold. Although it fell significantly in between, it reached new highs in subsequent years, and Fisher ultimately achieved a 30-fold return on investment. Next, let's look at parallel case study. His reasons for investing in Motorola. His reasons for investing were almost identical to those for Texas Instruments. At the time, Motorola wasn't prominent in semiconductors. Most investors saw it as just a TV and radio manufacturer, but Fisher was deeply impressed by its dominance in mobile communications. Through thorough investigation, Fisher learned the company strongly emphasized R&D. With sustained investment, they iterated products, established a dedicated semiconductor division, right as the industry entered its boom period.
Fisher concluded the company was entering rapid acceleration.
When researching companies, Fisher habitually looked for what they were doing that competitors weren't. He knew this was essential for industry leadership. During his Motorola investment,
Fisher witnessed something that cemented his conviction to hold.
In 1967, Motorola's management realized they were entering rapid growth. They specifically established an executive training institute to cultivate management talent. Amid intense business demands and internal skepticism about the training's cost and time, they persisted with the program. The other is when companies launch innovative products and services themselves, creating new market demand that drives performance growth. But strong demand alone isn't enough. Prosperity often attracts competition, intensifying market rivalry. Therefore, Fisher judged from the team's perspective whether a company could sustain future business growth. Fisher's second analytical point was whether the company prioritized new product R&D and its investment level. R&D costs money and rarely yields immediate results. But larger R&D investments mean greater future potential. Because R&D builds technical advantages, successful new products create growth opportunities that drive sustainable development. So R&D commitment is crucial in assessing growth potential. In today's fast-evolving tech landscape, top companies invest even more heavily in R&D. For example, in 2019, Apple invested 110 billion yuan in R&D, while Huawei invested even more, reaching 130 billion yuan. Fisher's third analytical point examines profitability, how strong the profit margins are, and whether the company emphasizes cost analysis and financial controls.
Typically, higher profit margins indicate stronger earning power, and industry leaders often boast the highest margins.
A key method to improve profit margins is cost control, especially for manufacturing companies. Having lower production costs than industry peers creates a powerful competitive advantage. Therefore, companies skilled at controlling costs typically achieve better profitability. But Fisher reminds us to examine future profit margin trends when investing. For example, a young company in its growth phase might buy equipment, expand production, build a sales team, market products, or develop new offerings. All of this requires significant spending. During this phase, high expenses temporarily depress profit margins. But if these investments fuel long-term growth, higher profitability will follow. Thus, temporarily weak profit figures are acceptable. In fact, this often presents a prime investment opportunity, since poor financial data leads to undervalued stock prices. Ultimately, Fisher sought companies with the strongest competitive advantages. These enterprises possess exceptional management and genuine strength across production, sales, R&D, and finance. By continuously innovating products or services, they lead industry trends and achieve revenue or profit growth far exceeding industry averages.
Meanwhile, their stocks haven't been chased by the market to overvalued levels.
As operating performance grows, stock prices will rise steadily over time. From 1954 to 1969, Fisher's most glorious period, his stock gains far surpassed market indices. Focusing on U.S. manufacturing stocks, Fisher excelled in electronics, chemicals, metallurgy, and machinery, with his investments in Dow Chemical, Texas Instruments, and Motorola becoming legendary successes. Next, we'll examine two of these case studies. First, Fisher's investment in Texas Instruments. In 1955, by chance, Fisher learned about Texas Instruments, a small company in the electronics industry. Its four founders planned to sell some shares to raise funds for buying land. After learning about it, Fisher conducted research and decided to accept the shares transferred by Texas Instruments founders. Both parties agreed on a price of $14 per share. Based on the next year's projected earnings per share, the transaction's price-to-earnings ratio was 20 times. According to the company's past performance and traditional market valuation standards, at the time, this deal seemed overpriced. Moreover, market investors classified small companies like Texas Instruments as speculative and weren't optimistic. But Fisher disagreed. After his research, he believed Texas Instruments had enormous potential in semiconductors due to its excellent management team with sharp market judgment, strong R&D focus, and automation drive to become the industry's largest and better lowest cost manufacturer. Fisher believed Texas Instruments management could compete against much larger industry players. Against giants like General Electric and Westinghouse, they could at least hold their own. Though much smaller than rivals, Texas Instruments commanded high product market share. Beyond semiconductors, its geophysical and military electronics businesses showed steady growth, yet the stock price didn't fully reflect these prospects. Looking back, we clearly see 1955 marked the start of America's 15-year golden age for semiconductors. From Fisher's 1955 purchase to 1962, Texas Instruments stock rose 14-fold. Despite significant pullbacks, it reached new highs later, ultimately giving Fisher a 30-fold return. Now let's examine Fisher's Motorola investment. His reasoning mirrored Texas Instruments' case. Motorola wasn't prominent in semiconductors then. Most saw it as a TV or radio maker. But Fisher recognized its dominance in mobile communications. Through deep investigation insight, Fisher learned Motorola emphasized R&D, had iterated products into a dedicated semiconductor division, perfectly timing the industry's boom. Fisher concluded the company was entering rapid acceleration. When researching companies, Fisher habitually looked for what they were doing that competitors weren't. He knew this was essential for industry leadership. During his Motorola investment, Fisher witnessed something that cemented his conviction. In 1967, Motorola's management realized they were entering rapid growth. They specifically established an executive training institute to cultivate management talent. Amid intense business demands and internal skepticism about the training's cost or time, they persisted with the program. By 1974, the institute had trained 400 Motorola executives, significantly enhancing management quality and meeting expansion needs, perfectly aligning with Fisher's investment criteria. Driven by a highly capable team, the company relentlessly pursued growth.
Fisher began buying Motorola stock in 1955.
Over the next 25 years, Motorola's stock rose 30-fold, becoming Fisher's largest holding. Fisher held Motorola shares until his death. All right, that covers Fisher's growth stock investment strategy. Next, we'll discuss Part 2, how to research companies. We've understood Fisher's analysis logic and investment principles. But translating investment research into practice isn't easy. Before investing, Fisher placed great importance on company investigations. Fisher's son recalled, "Between 1972 and 1982, my father and I visited countless companies. Before each visit, he'd prepare printed questions with space for notes." Beyond thorough preparation, Fisher could ask penetrating questions during management meetings. Questions that cut straight to the core. Beyond direct research, Fisher creatively developed methods for gathering information. The scuttlebutt method. Scuttlebutt is metaphorical, not casual chatting, but systematically interviewing suppliers, customers, ex-employees, competitors, associations, academics, and government researchers to form a complete company picture. In an era without computers or the internet, Fisher used the scuttlebutt method to build his unique edge in investment research. Fisher's investment story with Dow Chemical is a classic case of successfully applying the scuttlebutt method to research.
After World War II ended, Fisher chose to leave the military and restart his investment career.
At that time, Fisher set his main goal as finding America's most outstanding and promising chemical companies. He actively conversed with investors, operators, industry experts, university professors, and others knowledgeable in the field. This led him to notice Dow Chemical, and after visiting, Fisher recognized Dow's highly efficient management and emphasis on new product R&D. Moreover, as a tech-focused company, Dow also prioritized building its sales team. Fisher metaphorically said that Dow Chemical selected and trained salespeople with the same care as chemists. Ultimately, Fisher believed Dow Chemical best met his criteria.
So he started buying Dow Chemical stock in 1946.
Even in the 1950s, when Dow's stock performed poorly, Fisher held on to it.
Starting in 1960, Dow Chemical's stock soared, becoming a Wall Street legend.
Today, Dow Chemical is the world's second largest multinational chemical company, behind only DuPont. Dow Chemical always held a key place in Fisher's portfolio. He rarely failed, but like other masters, he couldn't win every time. Now, let's share a story of his investment loss. The reason for the failure was that Fisher let his guard down and didn't do thorough research. In the early 1960s, the U.S. pharmaceutical industry boomed, and Fisher began seeking investment opportunities there. So,
A pharmaceutical expert told Fisher that a small Midwest company was about to launch a new drug.
this drug had huge market potential and bright prospects. Fisher spoke with one of the company's executives and a few investors, all optimistic about the drug's future. And Fisher became interested, but he didn't verify with others in pharma or drug experts. Without the drug's potential profits, the stock wasn't cheap, meaning if profits fell short, the price would crash. Previous investment successes made Fisher complacent, so he started buying this company's stock. But the new drug underperformed sales expectations, and management had issues. After Fisher bought in, the stock kept falling, losing 60% of its value.
Ultimately, the small pharmaceutical company sold at a low price to a non-pharmaceutical firm, resulting in investment losses.
Fisher later discovered the initial investors hadn't properly researched the company. Reflecting on this lesson, he concluded, good luck breeds complacency. Had he strictly followed his investment principles and researched more thoroughly, he could have avoided this foolish loss.
Afterward, Fisher never again relaxed his research standards.
In a 1987 Forbes interview, Fisher stated, "The stock market intrinsically deceives investors. Following crowds or inner compulsions often proves wrong." Fisher also emphasized the concept of competence in research. Well, simply put, this means knowing yourself, understanding which investment areas suit you and which don't. While Buffett frequently stresses this, Fisher recognized it much earlier. He said, "My focus is manufacturing firms. They leverage scientific discoveries to expand markets. Other sectors like retail or finance offer great opportunities, but I'm not skilled there." Many investors fail by trying to cover everything, yet mastering nothing. All right, that covers company research. Next, part 3, when to buy and sell stocks. First, regarding buying opportunities. Fisher believed quality growth stocks are rarely cheap.
His advice: buy during market downturns or when mispricing makes stocks trade below intrinsic value.
Fisher rejected popular market timing strategies. Market timing, predicting buys or sells based on macroeconomic forecasts, has low success rates in Fisher's view. How to verify this judgment? He suggested finding old issues of the U.S. Commercial and Financial Chronicle to read economic commentaries and predictions from those years. Though many articles seemed logically compelling, reality later proved these predictions unreliable. For investment horizons, Fisher established a 3-year standard, believing short-term evaluations were inadequate.
As long as the investment met growth stock criteria, he'd hold for at least 3 years regardless of short-term price movements.
Only after 3 unprofitable years would he consider exiting. Fisher especially warned investors never to sell solely because of large price increases. Excellent growing companies deserve long-term holding. For selling stocks, Fisher provided 3 principles. First, sell when the original investment thesis becomes invalid or flawed. Second, sell when fundamentals deteriorate, especially if growth potential fades below overall economic growth rates. Third, sell to switch into better investment opportunities. When selling, Fisher noted investors must overcome psychological barriers like pride-driven denial that creates huge risks. Fisher advised, upon discovering mistakes, act decisively. Don't hesitate to admit errors. Finally, Fisher highlighted the need to avoid the PE ratio trap. The PE trap occurs when investors see a low ratio, assume the stock is cheap, and buy. But if fundamentals worsen and earnings shrink, prices keep falling. Ironically, the PE ratio might even rise. Fisher shared a personal experience illustrating this. After the 1929 U.S. stock crash, the Dow Jones fell from 386 points to 42, By 1932, nearly 90% in 3 bear market years. As an analyst at Anglo National Bank, young Fisher wrote an internal report predicting the crash, but underestimated its catastrophic scale. At that time, he was still constantly searching for and buying so-called cheap stocks with low price-to-earnings ratios. These companies with seemingly cheap stock prices had extremely fragile fundamentals under the impact of the Great Depression. In the stock market crash, prices plummeted drastically, turning the previously low price-to-earnings ratios into value traps for investments. In the bear market, Fisher nearly lost all his savings. After that, Fisher learned his lesson and never bought stocks solely because of low PE ratios again. On the other hand, Fisher also pointed out that one shouldn't simply conclude a stock is expensive just because its price-to-earnings ratio is high. Only when we thoroughly examine a company's operational capabilities and future growth prospects can we make a more objective judgment about its stock price. In investing, we've also experienced that truly great companies that grow consistently for many years often have stocks that seem expensive throughout.
That concludes the main content of the book, How to Choose Growth Stocks.
Philip Fisher's classic book, Common Stocks and Uncommon Profits, has been around for over half a century, and its investment wisdom has profoundly influenced countless investors, including Warren Buffett.
Even today, Fisher's investment insights still shine brightly and remain highly inspiring.
Fisher dedicated his entire life to finding outstanding growth companies, and his growth stock investments achieved tremendous success. After Fisher proposed the growth stock investment strategy, growth stocks gained popularity among mass investors. In most investors' eyes, growth stocks mean rapid and substantial price increases, so buying them can lead to quick windfall profits. But throughout investment history, after almost every frenzy of chasing growth stocks, it ends in chaos. The reason most investors fail isn't complicated. It's not that investing in growth stocks is wrong, but that they don't seriously research companies, blindly chase market favorites, and investing is always full of uncertainty. Number 2, requiring solid stock selection and research work. As Fisher said, to make big money in investing, one must have patience. I believe the future belongs to those who are disciplined and willing to put in the effort. I am both. All right, that concludes our interpretation of how to choose growth stocks. The reading notes are below the audio, and we'll see you next time.